Welcome to the Real Estate of Things podcast. I'm your host, Dalton Elliott. I'm joined today by the second most handsome guy at Lima One Capital. I'll let you guess who the most handsome guy is. Our CEO, Jeff Tennyson, is climbing mountains in South America right now. He's the third most handsome. But if he were here, I would say he's the first most handsome. So office politics at its finest. Josh, our wonderful Chief Financial Officer. How are you today, sir?
I'm good, Dalton. It's clear you know who pays for this podcast.
bingo. Better or worse. So no, you're the most handsome. You're dashing. I love that hair. Crisp white shirt. Can't get better than that. So give us some background. You're CFO. You truly, I've been here close to 8 years. In terms of tenure, you've been here longer, but I for some reason am taken back to one of the first big conferences we went to, and you were on stage with a bunch of other CEOs and CFOs, and I think you're 10 or 20 years younger than most of the folks in your seat. So truly impressive. You've led the firm through so much growth, through also some, I don't know if we call it, a little bit of crisis, right? When COVID hit, capital markets dried up. You kept the ship running from a numbers perspective, which is the most important perspective. So, you really are one of the trailblazers in this space. But give us some background on how you got to where you are in the CFO role.
Yeah, sure. I started in banking and mortgage finance literally when I was in high school. I know it still looks like I'm in high school, but I actually started in this sort of general space that long ago. And so I was at Bank of America about 11 years ago, and then I moved here to Lima One. And I'm telling you, it's been an incredible ride. It's funny because you sort of forget like how things were, and certainly the industry's evolved, and there's a lot more sort of availability of financing for our business, which has allowed us to provide more financing to clients. But it's just been tremendous to see not only product expansion, but geographic expansion, and just really proud of the solutions we've been able to build. We've obviously been fortunate to hire some really great people and build a great company along the way. And so, it's been a little bumpy last year and obviously 2020, but if you build a company that's nimble and can sort of adapt to any circumstance, then you're going to be able to navigate even difficult waters. And so that's really what we feel like we've done. And, that's why we feel like no matter what happens in the future, we don't have to predict the future. We just have to make sure that we do the little things well, and we'll be in a really good position to help grow our business and help our clients be successful along the way.
Yeah, really well said. And as we look at 2023, 2020, you had COVID. We as a space and us as a company, a couple months of, as capital markets were frozen, doing minimal lending. And then we came back with a vengeance and produced way more than we anticipated, even if you take COVID out. 2021, spectacular year for us, record year. But, rates went up. That was the big theme of 2022. If you could kind of read the tea leaves, what do you think the big story of 2023 is going to be?
So it's an interesting question. It's one that I know I've wrestled with as well as my peers and colleagues here. So let's just take and look at what the experts say, right? Like, I slept at the Holiday Inn Express of Greenville last night. So we'll just take a survey of kind of what most of the researchers and economic forecasters are predicting. And what the general consensus is what I would describe as okay to potentially, slightly negative. Now, this is purely from just a housing market perspective. And I draw that distinction importantly because then if you look a little bit sort of broader, like the total industry projections, and I see a lot more negativity, honestly. You hear a lot more, 30, 40, 50, 60% chance of recession. And so I do think that's a little incongruous, and it does make me wonder, like, if maybe we're being a little bit too optimistic with respect to the housing industry viewpoints. But look, like these things, if we look back to where we started 2022 and interest rates, for example, I think most people recognize that the quantitative easing of 2020 had come home to roost, and we needed to figure out ways to get inflation under control. And so people knew rates were going to go up. They knew the Fed was going to get involved, knew the Fed was going to tighten. But I think people thought, well, maybe it's 150, 300 basis points of tightening of Fed funds increase. And it was about 400. And it was probably much quicker than people anticipated. So the pace was really breathtaking. And so I guess to sort of answer your question directly, while I say I think things are going to be sort of okay overall from a housing market standpoint, I don't think we should underestimate sort of the firmness and fastness with which we can be wrong. And so there's a wide range of outcomes. And while the average, I think, of those outcomes is pretty fine, there's certainly some tails that we should be cautious about and keep in mind.
Yeah, that's a really good kind of box and whiskers plot reading of the tea leaves for it. And it feels like one of the more honest answers I've gotten as I ask folks in the space, like what do you think? And I think one thing, though, that I keep going back to is, when you look at housing, you have a lot of headwinds, but in my mind, one of the stronger pieces is that you still have a true inventory issue, right? Like when you look at the great, the financial crash, right? 07, 08, we were overbuilding, and then building just dropped off the edge of the cliff, right? And it never, up through COVID, it never got back to kind of a normal, healthy level, which means we still have a big deficit, millions of homes of a deficit for where we really need to be to have kind of a normalized housing economy. How big of a role do you think that's going to play in keeping the bottom from falling out in housing when you look at the kind of scenarios that are more in the worst case bucket?
So I actually have a little bit of a perhaps contrarian viewpoint there. This is fun, right? We're going to have a discussion. So, and I've said this a lot too, because what you're alluding to is exactly right. There is this extreme, like sort of underbuilding, the houses constructed versus the new households being formed. And I've heard anywhere, and in fact, I've said anywhere from like 4 to 6 million units short of housing. So let's just call it a 5 million unit housing shortage. But then I think about that and I say, okay, well, there's over 300 million people in this country. There's a little over 100 million households in this country. So, call it, 5% of households short. But then I also say to myself, it's like, wait a second, we're trending towards having less than 1 million existing homes for sale. And we're saying, wait, we actually need, another 4 million on top of that. And what I struggle to reconcile sometimes, like, okay, well, if we had 5 million homes today available for sale, like, would those really get absorbed? Or even if it was just rental units incrementally? I don't know. I'm not sure. I guess what I'm really saying is I think there's some sort of like natural, it's almost like unemployment. You'll never have 100% employment, so you'll never have like that quote unquote shortage completely filled. But with all that being said, I mean, it's still a fundamental supply versus demand problem. And that problem, I would say in 2007, 2008, whatever, like it was clearly like oversupply relative to demand. I don't see that being the same case here. And I know that's not necessarily a novel concept, but think about like any given market, right? Like there's certainly a multitude of factors that you have to consider. Like what's the net migration into that market? What's the absolute amount of housing transactions, housing demand, units that people desire in that market? Well, that's going to ultimately drive housing price in that market. And that demand is also going to be linked to things like interest rates, specifically purchase mortgage interest rates. And so I think it's almost like too simple to say that like, housing market is going to just be good because there's plenty of demand and there's not enough supply. Well, both of those things could be true, but if they're true in different places and one market has oversupply, like, a lot of California markets, a lot of higher end markets, like there's oversupply there. And so they're seeing decline in prices, where other markets where there's net inflow, the opposite is true, and there's still not enough houses for people to buy or rent. So I'll probably get into a little bit more, but I think that also speaks to like how you think about next year and how you sort of like take advantage of what opportunities do present themselves in today's conditions, which is a lot about playing into that like belly of the curve versus, going after sort of, I'll say the fringier elements of the housing market. And I'll define what I mean by fringier a little bit later too. But anyway, so I wax poetic a little bit there, but hopefully that answers your question.
No, I like it. It is a different view outlined than other folks I've spoken with on the podcast. And you mentioned kind of rates. Let's unpack rates and fees a little bit, right? Because the rate increase pain of 2022 is going to persist into 2023, right? It's that's the best guess is that we're going to continue to go up a little bit. How much further up do you see us going, and what impact do you think that's going to have on kind of production and availability in this space?
Yeah, it's a great question. So I'll separate what I'll say are sort of financing rates to borrowers, whether that's investor borrowers or owner occupant borrowers, versus like the cost of lenders to run their businesses, their cost of funds to go out and lend. So let's tackle that one first. So most of that is going to be driven by Fed funds, target rates, and what effectively banks are borrowing from each other at. Because whether you're a bank directly lending your own funds, whether you're a REIT, whether you're a hedge fund, even whether you're just raising capital independently, like your cost of capital is going to start with that risk-free rate. So you can find that as treasuries, you can find that as swaps, but there's that level that with virtually no risk, the risk of the U.S. government, you can borrow. And so like let's take 2-year treasuries. That's been sort of right around 4%. It's a little closer to 4.25% right now. We'll see how that changes every year, but like let's just say that it stays in this like call it 4 to 4.5% band. And I'm not saying that it will yet, but like let's just ride with that assumption for a moment. Well, the thing that I don't think people are appreciating enough is that that's really just a starting point, because like even if the Fed stops raising rates, which we know they're not, I think the forecast is like 5 to 5.5% Fed funds rate. Well, there's still going to be what's called a credit spread on top of that, which is to say like even if the risk-free rates are 4% or 4.25% or 4.5%, well, when I go out and make a real estate loan, like that's not a risk-free loan. So my cost of financing to go make that loan is going to be higher. And so what could actually happen, and what I think will probably happen we'll see some like flattening or at least slowing down of those risk-free rate increases. Again, remember, we started 2022 and it was basically zero, and now those risk-free rates are, in the 400 to 450 basis point range. So that's a precipitous increase. But what I don't think of really appreciating is how much incremental cost has been added because of this sort of perception of extra risk in the housing market today, particularly, but in other industries as well. We talked earlier about like recession forecasts. And so like, none of us business operators get to borrow at that risk-free cost. And so then we have to say, well, what risk is being prescribed to the businesses that we're running? And so for me, I promise I'm going somewhere. So it really wraps back around to like, what do we think house prices are going to do? And what do we think that market is going to look like, at least specific to our business and real estate lending? And so if you look at those forecasts, you've got anywhere from 5 to 10% up in house prices to 5 to 10% down in house prices. But again, there's a huge range of outcomes. And so like if on average we're at 0% home prices are flat this year, that's okay. And that probably won't cause us to incur a higher risk premium to our borrowing. But what is really important is to note is like if you start seeing delinquencies move and we start seeing delinquencies trend up, like that's going to keep the cost of funds elevated. So, I'll spare any more sort of like technical rates discussion for now, but like truly just that there's the risk-free, the Fed's fund that everybody sees and hears about, that's probably going up again another 100 basis points. at least. But then there's also this risk premium, which could also come in. Like we could also say like, hey, things are performing. We don't have really any issues. Delinquencies aren't going up. So, you could have the Fed funds rates go up, the credit spreads come down, and we're flat on rates by the end of the year. So rates for us to borrow, for lenders, for financiers to borrow. But then that will ultimately translate to cost of capital for borrowers as well. And, that'll get passed through almost one for one, in my view.
You touched on delinquency, and I know for any lender, that's a massive part of the business, right? Like managing delinquencies, loans that you take back, properties you take back. How have, what's the trend been in delinquencies recently? And do you have any thoughts on or any predictions for this year? Do you think there's going to be kind of a flood of foreclosures? What do you think?
Yeah, I'll be honest. I'm not sure. I've seen sort of mixed data on it. I've seen, commercial side, your classic, retail is struggling a bit more, kind of 7, 8, 10% delinquencies. By the way, it's important to define like what delinquency is. It 60 days past due? Is it, in foreclosure, especially service? But like, I'll just say kind of 60-day past due rates, all the way up, of course, through special servicing foreclosure. I haven't seen as much distress in housing, like in terms of those delinquency metrics, at least not in what I've seen in the MBA production information. But like, there has been more murmuring about more foreclosures coming through. So, perhaps that's a canary in the coal mine. On the, I guess, business purpose lending space specifically, yeah, I mean, there really hasn't been any. And, maybe that is also a testament to just the operators in this space and how quickly they're able to adjust and, understand what's going on locally and, adjust their business model accordingly. As for going forward, I'll tie it right back into home prices, but not just like the pure number, right? Because, we could have 0% home price appreciation next year, but, if you have down 20% in the first 6 months and 20% up in the last 6 months, like you're still at 0% on average, but that's obviously a big difference in scenarios versus just a flat 0%. So I think the timing and the pace of house price changes is really important. Again, in this sort of business purpose lending, construction, rehab lending, value add lending space, that's going to really tell the tale of how well our operators are able to navigate and again, adjust their business models. I will just note on inflation, these things aren't free, right? Like, we sort of seem like it's some just thing happening, but like, it's really increasing the costs of projects and it's really making the numbers harder, right? All the inputs, labor, materials, those have gone up. Because those have gone up, it's harder to make the numbers work. And so, I think there's some other reasons that you're seeing investor purchases decline by 30%. It's not just purely a function of rates going up and that cost increasing, but literally just the projects themselves don't make as much sense as they did a year ago.
Yeah, especially on the short-term side of the fence, and even right, you have rates up and rents have continued to grow, but I think I've seen the estimates on rent rate increases for 2023 have pulled back some. Thinking back even 3-4 months ago, I think estimates were 6-7%. You would see some wild estimates at 10%, but it seems like most of them were at 6-7%, and now it's pulled back to kind of the 3-4% range, which is healthy, nothing to scoff at, but certainly a normalization and a pulling back from the last couple of years where you've just had insane rent rate increases. But go ahead.
Well, yeah, no, and it's in a lot of ways, my personal view is that's super healthy. I mean, we need that. Like it's unsustainable. Affordability is at a fever pitch, not even just for buying houses, but renting houses as well. And so, again, back to supply demand. Like there's only so much demand when you've got to pay 35-40% of your income to be able to buy a house or rent a house. But the rent is an important point too. I think that's going to be especially tied into what happens with unemployment. unemployment, it's been very strong, right? In that, like, we're almost at full employment, and we just haven't really seen that retrace at all. And there's been some more like tech. You started to hear a little bit more tech, Silicon Valley, those types of layoffs. I think that's going to be key as well, especially with respect to the rental business and how that functions going forward. To some extent, the Fed's told us that for inflation to really come down and get kind of closer to that 2% target, I mean, right, like we're at 7% now. For us to get closer to 2%, like unemployment has to go up. Like that just, I mean, it's counterintuitive in some ways, but like I just don't see a world where where those two things can be true, that you're at, a 2% or 2% inflation rate and unemployment is still at 3.5%, right? Like that's just mathematically difficult. And so when that unemployment does start to creep up, I think, consensus estimates are somewhere in the 5% range. Like 2% doesn't sound like a lot, but when you really think about the magnitude of that, like I do have concerns that could cause some ripple effects in both owner occupied and rental housing. And so that's something that I'm keeping an eye on as well.
Yeah, I was reading last night just some estimates and guesses about, knowing that unemployment has to rise and normalize. And you and I were talking before this started that, you were probably introduced to this concept the same time I was, which was early on in college in economics classes, that 0% unemployment is not healthy, right? Because then there's no mobility. Right. Go down the line. We could talk about Adam Smith and everybody else, but we'll save that for another podcast.
Yeah, you might have people unsubscribing as we speak on that one.
Precipitous unsubscribing. It'll be just like the unemployment rate. Just no.
Yeah, I know. I might be killing some subscribers myself here, but we'll keep trying.
But yeah, that 3, 4, 5% rate. And one thing that I found interesting is I saw a lot of talk about who it hits being different, right? You mentioned tech layoffs. You've seen, it hitting higher paying jobs. Whenever you look back to 07, 08, you had finance just demolished, right? That more so than any other space. And then you had kind of the retail, more of the frontline workers being laid off. Looking at estimates for this year, and as we know that most likely unemployment's going to tick up, and that's healthy. The consensus I was reading was that white collar workers are going to be, and that's a term that was used. White collar workers, the more traditional.
Are you making fun because I literally have a white collar on? I'm literally wearing a white collar. Is that what this is about?
I have some news for you, Josh. I'm going to be okay. You on the other hand, I'm for anybody listening, I have a green collar on. Josh has a white collar on. I'll let you know where that goes conversation-wise. But my prospects are looking good. No, it's interesting that's what is going to be hit. And some of the logic behind it was that the shortage you've had, and for our operators, partners in the space, so the folks who are, working with us on the fix and flip, new construction, multifamily, rental fronts, they've had the last couple of years a really tough time with labor, not only finding labor, but the compensation has gone up. And so that cuts into margins. But, what I've read and how it seems to tie into our space is that, the manual labor jobs and, the more blue collar jobs, employers are really going to try to hang on to those folks, knowing how hard it has been to fill those spots. And that those jobs are generally like you can't shift over that work to somebody else and have the same outcome, right? You need boots on the ground to build homes, to fix up. And seeing that potentially the hits are going to be more in the white collar side of the fence. So how do you think from an operator standpoint, when I try to put myself in their shoes, a lot of the homes, our average uh, loan and then after repair value. So the actual average sales price for a property that we lend on is probably somewhere in the 300 to 500 range. That's probably the band. How do you think that the creeping up unemployment is going to affect operators, like the average operator in this space for new construction or rehab project?
Yeah, it's a fascinating dynamic between the white collar and I'll say more of the blue collar workforce. I don't see a lot of changing of demand for construction without material continued sustained high interest rates. And the reason is we've seen it, right? Like in our lending practice, like construction costs had come in some, like material costs had come in some, but labor remained stubborn. And so it just, as long as there are houses that need to be built, at least the current levels, then, there's not today more people coming into that workforce. So I think there's a big time labor supply constraint with respect to construction. And that goes back to the math equation I was talking about earlier, where, if you're an operator and you're trying to do a project, like the numbers just get tighter and tighter because you're paying 10, 15, 20% more for labor. Maybe materials are only 10% more, but that starts to add up. Oh, by the way, now, like in your model, you've got to say, well, I think the house is worth 400,000, but maybe it's only worth 350 or 300 because of factors that I can't necessarily control. So that's why one of the several reasons why I think you see investor purchases of real estate going down. I think Adam put out a statistic that said it was 30%. Investor purchases are down 30%. That's where you really see it manifest. And then a little bit maybe of a knock on, but with respect to like the higher paying jobs, the white collar jobs, as or if those do go away, I think it really challenges, I'll call it sort of the luxury or higher end market. And we're already seeing some of this where luxury home prices are going down at a pretty rapid clip, 20 to 30% in some markets. So I talked about like fringier places earlier where maybe you want to be a little bit more cautious. Like if you're a luxury spec builder right now, like that's a place where you've got to put even more cushion in your model for labor and materials, but then also some of those potential home price decreases. And of course, it's all local and every project specific, but we're speaking in, I guess, broad generalizations here. So I think that surveys and addresses some of the questions and issues you brought up, but there's unfortunately no real easy solution or one straight answer to it. I think it's just a combination of factors that have to be evaluated on each deal.
For sure. Yeah. Super local. And you and I were in credit review committee yesterday and the Austin market came up and, that's a market that had the most, at least from a headline perspective, the most notable market in terms of growth the last couple of years, 35 or so % growth, which is just absolutely wild. And subsequently that market is seeing one of the more precipitous normalizations, I guess I would call it. I struggle to call it a drop off because, the levels that it seems like it's going to normalize to or level off to still outpaces what normal appreciation would have been the last couple of years. So I think you have to take a global perspective when you look at housing and say, sure, some markets are going to come back and cool off, but even if you see a little bit of negative growth there, if you look at a 24 or 36 month window, still well above where you would normally expect home prices to appreciate over those few years. So I think that's something super important to keep in mind as well. But as we
100%.
Yeah, and as we look to wrap up, what else is on your radar for this year for operators from a lending perspective? Any markets that excite you? I'll just open it up to you. What's kicking around in the brain?
How much time you got? I mean, that could take a while. No, I'll put it this way. I don't. It's hard to paint with a broad brush. You get this question a good bit about like, what markets are good, what markets are bad. So like, of course, you can look and you say, all right, well, there's certain states Texas, Arizona, Florida, North Carolina, South Carolina, Georgia, like mathematically, definitively, they have net migration. Okay, so theoretically, more demand for housing, or not even theoretically, actually, more demand for housing. There's other states, New York, California, Massachusetts, net departure, so less demand. So, I mean, again, if you're trying to just paint with a broad brush and say, like, what are the places where I want more or less exposure to housing, like those are probably some states that you would want to pay attention to. But the reality is, like, very few of us operate at like a state level or even a MSA or city level, right? Like, we're dealing in neighborhoods and zip codes and things like that. And so, I mean, the way I think about it, if I'm buying a house, like the potential change in pricing for that market is a factor. But what's more of a factor is, am I buying it right? What are my inputs on materials and labor? What are the immediate comps in that area? What have they looked like over the last 6 to 12 months? And so I mentioned earlier, like, kind of fringier products and projects. I think there's just certain projects that it's harder to line up all those variables. I mean, build to rent's one that, when it works, it's great, but it's just hard to get all the stars to align because you got to buy the land right, and you got to make sure you got the demand there in terms of net new rental demand. You're not just competing against sort of the apartment complex, you're also competing against the option to buy. And so you got to, kind of strike that balance between being affordable enough that, like, you're better off renting, but, making sure that you can kind of hit your operational numbers. I talked about luxury, like that those can be home runs, and, those can also be really hard houses to sell that take a long time. But so for me, as I put my investor hat on or put myself in the shoes of our clients, I think about, like, how do I do projects that are just like right in the belly of the curve, right? Those, available for a single first-time home buyer all the way to the, person who's downsizing, that just gives you sort of up and downstream receptivity. And again, that price point will be different for each market, but we're really talking about sort of the central infill type development housing that makes that's in the highest demand, right? Again, it's in that belly of the curve. And then on the rental side, that would be more of like your Class B apartment complexes. I mean, I really like, taking a Class C, doing value add. Not only does that create more better units, but you've got your Class A tenants who, let's say they lose their job or they take a pay cut or whatever, like, they can always come down. And then that Class B is really where, kind of 60 to 70% of the demand is anyways. And so I just think those are the places that you really want to target as an investor and as a lender, and really as anyone who's trying to put some chips out in the housing market.
Yeah, not the time, or at least it doesn't seem like now's the time to be real risky and frisky, right? Like, crunch numbers a little more deeply, have more conservative estimates, know that past performance is not indicative of
yeah. Well, what do they say? Fortune favors the bold. Yeah, I mean, that might be true, but I would suggest that now is a good time to make sure you got just a little extra margin in your deals. You're buying it even more right than before. You're really making sure that you got some excess spread between your costs and your expected sales price. And also you got extra liquidity, because we didn't talk a lot about time to sell, but we are starting to see time to sell stretch. So, it's not just that you only have 5 potential buyers instead of 10. It's taken 100 days to sell instead of 60, and so that's something that is also important to be cognizant of.
Yeah, really good call out. As I may be the most handsome person in the company, but I think you're the smartest person in the company. So we could sit here all day, and I have a million questions. But thank you for carving out some time and chatting with me through this. I really, really appreciate it. And I always benefit greatly listening to you and going back and forth, picking your brain. And I certainly know the audience will as well. So thank you very much, Josh. I really appreciate it.
Well, I love it. I appreciate you. Thanks, everybody, for listening, and really enjoyed being on today. So we'll talk again soon.
Beautiful. Thanks again, everybody. Take care.